For years, Chipotle was treated like a safe bet. A brand that somehow cracked the code. Clean ingredients, fast service, premium pricing, and a loyal crowd that kept coming back no matter how expensive burritos became. But something has changed, and not quietly. Something underneath the surface has started to break. And the scariest part is not what already happened in 2025. It's what Chipotle's own executives are admitting will happen next. Because when a restaurant chain openly tells investors, "We don't expect more customers to come in this year," that's not confidence. That's resignation. Chipotle just finished a full year of declining foot traffic. Not one bad quarter. Not a seasonal dip. A full year where fewer people walked through their doors. At the same time, their stock lost roughly a third of its value. That's not market noise. That's the market reacting to something fundamental going wrong. And instead of signaling a comeback, the company's outlook for 2026 quietly confirms the damage may already be baked in. Executives are now guiding investors to expect flat same-store sales. In simple terms, they don't believe more customers are coming. For a business built on volume, speed, and repetition, that's a dangerous place to be. Restaurants don't survive on vibes. They survive on bodies moving through the line. But what makes this situation unsettling is not just the numbers. It's the mindset behind them. During a year when nearly every restaurant chain acknowledged consumers were stretched thin, Chipotle chose a different narrative. Their leadership openly stated they would not lower prices to attract customers. That statement alone should have raised alarms, because it assumes Chipotle exists outside the laws of basic economics. As if fast casual somehow floats above inflation, wage pressure, rent hikes, and shrinking wallets. Yes, Chipotle food is better than most fast food, but customers don't compare restaurants in isolation. They compare them at checkout. And when a burrito starts feeling like a luxury purchase instead of a habit, behavior changes quietly, then suddenly. Instead of adapting to that reality, Chipotle leaned into a different idea. One that sounds smart in boardrooms, but dangerous in the real world. They decided to focus on the wealthy. Executives revealed internal research showing that roughly 60% of their core users come from households earning over $100,000 a year. That data gave them confidence to raise prices again. Confidence to design the brand around high-income, digital-native consumers who value protein, clean ingredients, and purpose-driven branding. And here's where things get uncomfortable. Because high-income customers don't fix traffic problems. They never have. Chipotle's entire business model was built on density, high throughput, long lines moving fast, lunch crowds stacked shoulder to shoulder. That's how margins worked. That's how expansion worked. But wealthy customers don't eat out of habit. They eat out of choice. And they don't show up daily. So when Chipotle says it's leaning into higher income guests, what it's really saying is this: we are accepting fewer customers and trying to make more money from each one. That strategy can stabilize revenue temporarily, but it breaks the engine that made Chipotle what it was. And the cracks are already showing. Despite declining traffic, Chipotle plans to raise prices again, 1 to 2%, for now. But anyone who's followed this company knows that's rarely the final number. Price hikes have a habit of coming in waves. And all of this is happening while executives admit margins will remain under pressure in 2026. So what's the solution? Apparently, protein cups. Yes, cups of meat. Chicken for over $4, steak for over $6. The same protein you could already add to a burrito, now separated, rebranded, and sold as a snack. It's not innovation. It's rearranging the same pieces and hoping no one notices. This is where the strategy starts to feel detached from reality. Because customers aren't confused about Chipotle's menu. They're confused about its value. And offering a cup of chicken doesn't fix that. It just highlights how expensive everything has become. Some analysts have said it out loud. Chipotle doesn't need another premium add-on. It needs value. A simple, accessible option that keeps people coming back out of convenience, not philosophy. But that idea clashes with the brand identity executives have built in their heads. And this is where the story takes a darker turn. Because when leadership openly designs a business around wealthier consumers, it quietly tells everyone else they no longer matter. That's a risky message for a chain that scaled itself on being a repeat lunch option for millions of ordinary people. Once convenience starts to feel like a bad deal, habits disappear. Visits become occasional, lines thin out. And suddenly, stores that were designed for constant motion feel empty. Many people have noticed this shift without even realizing it. Places that used to feel crowded now feel quiet. Visits that used to be weekly become monthly. Not because people stopped liking the food, but because the math stopped making sense. Executives claim they've solved this by gamifying the ordering experience. Rewards, digital nudges, behavioral tricks designed to bring younger customers back. If that's true, it's unsettling. If it's corporate jargon, it's worse. Because neither fixes the core issue, people feel priced out. And here's the midpoint truth that should worry investors the most. A full year of declining traffic is not a blip, it's a signal. And flat growth guidance is an admission that leadership doesn't expect that signal to reverse anytime soon. The current CEO has been in charge for less than 2 years. Since then, the stock has been cut nearly in half. And the proposed fix, higher prices, wealthier customers, protein cups, doesn't inspire confidence that the core problem is understood. Now, to be clear, Chipotle is not collapsing tomorrow. The company still generates billions in revenue, hundreds of millions in profit. They plan to open hundreds of new locations. This isn't a bankruptcy story, but it is a warning story. Because in today's market, stability isn't enough. Companies are expected to grow endlessly. And when growth slows, even modestly, the system punishes them. It's unsustainable, and it's quietly breaking businesses that once felt untouchable. Chipotle's situation isn't just about burritos. It's about what happens when pricing, inequality, and consumer fatigue collide. When brands choose who they serve, and who they leave behind. If traffic doesn't return, expansion becomes riskier. New stores cannibalize old ones, margins tighten, loyalty fades, and what looks like strength on a spreadsheet starts to feel fragile in real life. That's why this matters. Not because Chipotle is failing, but because it's changing. And history shows that when companies abandon the habits that built them, they don't notice the damage until it's irreversible. And that brings us to the uncomfortable question nobody wants to ask yet. If a brand as powerful as Chipotle is struggling to bring people through the door, what does that say about the rest of the industry? If you enjoy breaking down complex stories like this, where economics, psychology, and real-world consequences collide, this is exactly what we do here on Odd World Files. We explore the hidden mechanics behind the systems shaping our world, using logic, data, and stories that most people never connect. So if you're new here, make sure you subscribe to Odd World Files, because the surface story is rarely the real one, and things are often far worse than they appear.